June quarter financial performance of Cummins India was one of the worst seen in its own history, and so the hit to the share prices wasn't definitely unexpected or shocking. Now, the stock price also has been hammered again in the recent market volatility, dropping from levels of seen, say, about 500 rupees per share to currently where it is trading around 450 rupees per share. In our ideas for profit today, we'll discuss and find out if investors should keep an eye on this stock as the valuations now have turned quite attractive. Let's focus on the Q1 earnings first. During Q1, the company reported a steep 63% drop in the revenues hit by the lockdown as well as the other issues that were impacting the execution as well as the deliveries in that quarter. Now, there was no respite both in the international or the domestic markets where it operates in. Also, if you see exports, for instance, saw a 61% drop, which is similar to about 64% drop that was seen in the domestic business as well. So equally, it was a massive disruption. The drop in the business as well as the higher cost in addition to the lower capacity utilization, they all cumulatively have hit earnings. Thankfully, the environment now is not as poor as that was seen in Q1. While the exports, which account for about 26% of the total revenues, that could grow slowly, also in the light of the lower demand currently. But the domestic market could actually see a good revival this time around, or maybe in the second half. The power gen segment, which is the prime business of the company, is actually witnessing recovery, particularly when you talk about from the healthcare segment, from telecom, small businesses, food processing industries, all of these, etc. Now, the company is also making efforts to piggyback on the sectors which are relatively insulated from the stress that we are seeing across industries, say railways, highway construction, oil and gas, and all the other high-end engineering applications. So this is what the company is backing on. Now, with the help of the parent company, it has also invested both in the technology as well as funds in the recent past to develop superior energy efficient products and also to develop solutions which are suitable to meet the global emission norms, catering to different industries. Now, while the implementation of these norms, for instance, for the construction equipment, etc., or maybe for agriculture, tractors and others, they have been delayed in India because of the COVID-19 situation. It is still expected to pick up most likely by, say, late 2021 or early fiscal year of 2022. Now, it was also initiated significant cost-cutting program to bring down the operational cost in a bid to save money and deal with the competition and also to conserve cash. Thankfully, the company is really sitting on a good cash and liquid investments of, say, about 1,000 crore rupees. And that said, it will definitely conserve cash in addition to having strict control over the working capital going forward also. So to sum it up, recovery will be visible only in the second half. That is what we need to be prepared about, which should be good enough to make up for the decline that has been seen in the first half already. Also, thus, we do not expect major drop in annual revenue and profits this year. However, when you talk about next fiscal year, the recovery could be very strong both in terms of revenues and earnings that will be led by the expansion in the margins and also the higher utilization levels as well. The good thing is that the market has not started visualizing these things as of now, and thus the margins of safety and scope for re-rating from the current levels are quite high. The stock is currently trading at 21 times the estimated earnings and 2.4 times the price to book value of FY22. Historically, its stock has traded at an average of 5.2 times book value also. Moreover, at the current levels, the stock is offering a close to 4% dividend yield, which is good enough to also support the price. Now, valuations also look quite attractive from the perspective of the cash in the books, the strong balance sheet, and also the leading position that the company commands in the industry as well.